Hello, welcome back to LearnOikonomia. Having discussed the concept of aggregate demand in detail in the previous video, we in this video express or explain what is known as the aggregate demand shift and how does this happen. All these are the concepts or the details of this particular video. So let's go to the video and see how does aggregate demand shift. As I have already explained to you in the video, which I have already mentioned, where we had discussed in detail the concept of aggregate demand. The concept has been explained in detail, so you can go to that video and come back to this to see how does aggregate demand shift. Anyway, for your information, I'm telling you the concept of aggregate demand again, so that you could use it for further reference. So this concept of aggregate demand involves the total amount of goods and services which the consumers are willing to purchase in a given economy during a certain period. So this is very important. That is aggregate demand. So the total, that the aggregate, it is from the word total that the word aggregate comes. So the word aggregate and the total are important here. So the word aggregate demand is sometimes we could see that the word changes in the way that alters its relationship with aggregate supply. We know whenever the aggregate demand curve intersects the aggregate supply curve, we could get the equilibrium price and equilibrium quantity, right? So starting from the point of equilibrium, whenever there is a shift in the aggregate demand curve, that can have its implication on the price level as well as on the output level, right? So we have to see how does this aggregate demand shift and what are its implications. Since modern economists calculate aggregate demand using specific formula, shifts result from changes in the value of the formula's input variables like consumer spending, investment spending, government spending, exports, imports. That too would have its implications. We know that it is the totality of consumer spending, investment spending, government spending, and net exports that would lead to what is known as aggregate demand in the economy. And whenever there's a change in any one of these variables, that would have its implication upon what is known as aggregate demand, right? So, any aggregate economic phenomena that cause changes in the value of any of these variables will definitely have its implication upon aggregate demand, and this will lead to a shift in what is known as aggregate demand. This can be a downward shift or an upward shift. It depends whether consumption expenditure is increasing or decreasing. It depends on whether the investment expenditure is increasing or decreasing. It depends on whether the government expenditure is increasing or decreasing, or it depends on how and whether the net exports is increasing or decreasing. So all these matter to the shift nature of what is known as aggregate demand, right? If the aggregate supply remains unchanged, so this is our basic assumption. Just assume that the aggregate supply curve is unchanged or it is constant. In this scenario, a change in aggregate demand would shift the aggregate demand curve to the left direction or to the right direction. It depends. So it depends on whether the factors affecting aggregate demand is increasing or decreasing, or whether it is changing favorably or unfavorably. However, this is not always the case. For instance, a reduction in aggregate demand might be engineered by a government to reduce inflation, which is not necessarily something negative, right? So there can be instances like these as well. Coming specifically to shifting aggregate demand curve, we can see that it can either shift rightward or it can shift leftward. So consumers they might spend less because they could see that the cost of living is increasing, or they could see that the government taxes have increased. So as a result, they think that it is better to spend less. So as a result, they decide to spend less because they are saving a lot of money in the expectation that prices are increasing in the future. So in order to deal with the increased future prices in the future, they are saving a lot of money now. This will have implication upon the aggregate demand curve. It might be a consumer time preference that change the consumption of present to deal with their future consumption, and they have to manage their present consumption and future consumption. So as a result, they will be making their adjustments in the spending pattern. Also, we can see that a contractionary fiscal policy, like an increase in taxation or reduction in public expenditure, this will have its implication upon aggregate demand. A contractionary fiscal policy in the form of an increased tax rate or a reduction in the a reduction in the government expenditure can shift aggregate demand to the left. This is because the government would be deciding to increase taxation, or they would be deciding to reduce their expenditure with some kind of planning in their mind. So they will be having some plans in their mind. So as a result, to deal with these, they will be going for a deficit budget. Monetary policy has less immediate effect here. That means that if monetary policy raises the interest rate, then individuals as well as business, they would tend to borrow less because they would be saving a lot of money here. This too have its implication upon aggregate demand. The aggregate demand would shift to left. Now, the last variable here is net exports, right? That is exports minus imports. This is less something which is less direct and more controversial. A country's current account deficit or surplus. So, if the and that can be the two situations that a country could face. Even though we say that a country's balance of payment should be in a balanced form, that is not possible in many ways, because that is actually an ideal phenomenon or ideal situation. But usually the case is a country's current account deficit is a possible scenario, and also a country's current account surplus is another possible scenario. A country's current account surplus is always balanced by a change in the capital account, and this would imply a net influx of foreign currency, or currency is flowing to your country from abroad. So this situation will lead to an increase in the US foreign currency holdings or influx of US dollars. Just take the example of US dollars. That doesn't mean that only US dollar is coming to your country. There have been many other currencies, but since we are dealing with the international transactions in terms of US dollars, just take the example or just take that case here. So we can see that here your US dollar is flowing to your country. As a result, that too will have its implication on aggregate demand curve. So what does aggregate demand shock mean? So another important concept here. As per many macroeconomists, a demand shock is an important change where the economy is affected a lot. Your spending decisions are affected. This would cause a sudden or unexpected change or shift in your demand curve, your aggregate demand curve. Some shocks are caused by change in technology, technological advances, many productive measures with respect to labor, many productive measures with respect to capital. All these would have its implications on aggregate demand. So this is normally caused by declining cost in one or more sectors, leaving more room for consumers to buy additional goods. So in this case, we can see that the demand for total goods and services would increase. At the same time, the prices are falling. So these are the two different things that you can see simultaneously. In the case of diseases, natural disasters, here negative demand shocks, if they limit the earnings and cause consumers to buy fewer goods, so that too can be considered as an instance. Also, we can see that natural disasters like Hurricane Katrina, they would be having some negative implications on the supply. Your supply would be reducing as a result of supply shocks. Then you can see that world wars uh, between different countries. So that can be considered as a shock. So all these would have implications upon your aggregate demand curve. That means that if your government expenditure is increasing, if your consumption is increasing, if your investment is increasing, if your exports is increasing compared to your imports, then your aggregate demand curve will shift to right. On the other hand, If your consumption is falling, if your investment is falling, if your government expenditure is falling, and your imports are more than your exports, that means that your aggregate demand would shift to left. So that is the what to say, in a nutshell, that is the idea. So I hope you could have some kind of understanding with respect to aggregate demand and how it is shifting, and what are the factors that is leading to shift in aggregate demand curve. So that's all for today. Please like, share, and subscribe to this channel for more videos, and you can be a part of my Telegram channel and Telegram group. You can join there. I'll be giving the links of these in the description box. So that's all for today. Thank you for watching.